for 12, 18, or 24 months. Keep this in mind, though. Again, the small print is the issuer. When they do these deals, they will usually charge you a transfer fee, and that typically is going to range from 3 to 5%. So if you did a balance transfer of $10,000 and it was 0% interest for a year, they may charge you 4% up front, which means your interest rate essentially was 4% for the year. Simple math. It's more complex a calculation than that, but you get the idea. So be very aware of that because you do have to look pretty closely in the credit card issuer's documents to find that. So make sure you pay attention to that. They're typically not going to give you 0% for 2 years without an upfront transfer fee. There are times, especially in the distant past, where I did do balance transfers that literally were 0 upfront fee and 0% interest for a period of time. But I think that doesn't exist in today's environment. So look for the upfront cost. Another thing is, and you see a lot of advertisements for this, is that you could do a debt consolidation and you could go to a debt consolidation company. I am very much against that. I believe that's bad. That industry has way, way too much sleaze for anyone I know. And even if I don't know you, I wouldn't suggest you get involved in that. There's a lot of bad actors, very sleazy. They do a lot of bad things. They're going to destroy your credit. It's just a mess. You do not want to do debt consolidation loans through debt consolidation companies. Now, you can do debt consolidation where if you, let's say, could get a personal loan from the bank at a reasonable interest rate, and you had 3, 4, 5 credit cards that were at higher interest rates, you could consolidate that debt and save on interest. But then you're dealing with a reputable institution and not some sleazy debt consolidation firm. Now, there's probably some good debt consolidation firms out there. I'm painting with a very broad brush, but seriously, don't get involved with debt consolidation firms. Buyer beware. So you could consolidate your student loan debt too, and there are some institutions like SoFi, for example, that has staked out a nice market for themselves, helping individuals refinance their student loans. Because if your student loans are 5, 6, 7, 8%, and you can refinance that debt at lower interest rates, you may want to consider that. If you have lots of credit card debt, and you could get it to one credit card that might have a lower interest rate, either a teaser deal or a non-teaser deal, you may want to consider that because you're saving interest costs. Another way that you can consolidate debt is by using the equity in your home. There is a second mortgage product out there called a home equity line of credit. It's called a HELOC. So if you want to feel really cool at the next party you go to, you could throw around the term a HELOC, HELOC. But HELOC, because it's backed and collateralized by your home, often has lower interest rates than the other lending vehicles we've talked about so far. Typically, a home equity line of credit is going to have a lower interest rate than credit cards, student loans, and possibly car loans. And so that's another way you could consolidate it. And you could take debt and you could put it against the equity in your home by borrowing more money based on the value of your home at very attractive interest rates. So that's another neat debt consolidation strategy that I would approve of, unlike going to the bad debt consolidation companies. The thing about all of these strategies where you take debt and you refinance it to lower rates and or more favorable terms is that you want to be extremely careful, because if you don't change your behavior and you don't have a plan to pay off the debt, you are not really accomplishing that much. So to give you an example, let's say you had some credit card debt and car loan and you were motivated by maybe my commentary today, and you got a home equity line of credit and you cleaned up your couple of credit cards and your car loan, you put it on the home equity line of credit, you reduce your interest rate, You go from several debts, which might be a little overwhelming, to one debt, and you're happy and you're satisfied and you celebrate with a glass of wine or a cocktail tonight. But if you go about spending and living your life like you did before financially, and within a few years you have built up debt in other places, you really didn't accomplish anything. These consolidation strategies that I'm in favor of really will only work if you have a plan to pay them down, and most importantly, you live beneath your means and don't accumulate debt elsewhere. Because when you pay off these other credit cards, in my dopey example where you pay off the credit cards and you put it on the home equity line of credit, that's pretty good. That's good. But if then you say, oh, I have no credit card debt, I could start charging, and I used to have $10,000 in credit card debt. Now, well, what's the big deal if I charge $1,000 to go on this trip I want to go on? Well, it is a problem because you didn't really pay off the credit card. The debt from the credit card's now against your home, and that puts your home at risk. So you want to do these things, but you do need to change behavior and not accumulate debt on top of what you just refinanced. Otherwise, you're going to make the situation much worse for yourself. So some strategies we covered: the snowball method, the avalanche method, separating out consumer debt, those not backed by assets, personal loans, credit cards, student loans. I'm going to throw car loans in there because I think far too many Americans overbuy their car and have payments that really strangle their ability to build wealth and put a lot of pressure on themselves. We talked about doing balance transfers with credit card issuers. We talked about the hazards of dealing with sleazy debt consolidation firms. But we did talk about consolidating debt, student loans, refinancing debt, maybe going to the bank and getting a loan where you could lower your interest rate, also accessing the equity in your home through a home equity line of credit. I'll kind of throw in as we're wrapping up here, sometimes it will also make sense to refinance your debt along with your first mortgage and just wrap it into the whole mortgage. But again, if you do that and then go about spending out of control and building up debt, you really made things worse for yourself. We talked about changing behavior. If you want to build wealth, you don't want to be strangled by debt. And if you want to save and invest money, you can't have a lot of payments going out the door to service debt. And if you want to have less pressure month to month where you're in this rat race, paying off debt, freeing up your income is very liberating. So thank you for listening to this episode of the Simply Financial Podcast. I'll be back with you on an upcoming episode very soon. In the meantime, we would love it if you'd subscribe to this podcast and encourage friends, family, coworkers to subscribe to it also. If you're interested in finding out more about me and the services that my team and I provide at Elliott Wealth Management Services, you could go to the Elliott Wealth website. That's 2 L's and 2 T's. You'll get information about me and the team and how we help our clients win with money. If you're not a client, at the website, you could sign up for a complimentary consultation where we could talk about you, your goals, your debt management plan, and how we might be able to help you. So thanks again for listening.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.
Simply Financial is part of the Exvadio Podcast Network. You can find Exvadio podcasts at exvadio.com/podcast, the Apple Podcasts app, iTunes Store, iHeartRadio app, Spotify, Stitcher, and wherever you find podcasts. So join us and stay informed and entertained.